This class is about cash conversion cycle. The cash conversion cycle is a cash flow calculations that attempts to measure the time it takes a company to convert its investment in inventory and other resource inputs into cash. In other words, the cash conversion cycle calculations measures how long cash is tied up in inventory before the inventory is sold and the cash is collected from customers. Cash conversion cycle attempts to measure how long each net input dollar is tied up in the production and sales process before it gets converted into cash received. In simple words, you can say that this cycle takes into account how much time the company need to sell its inventory, how much time it takes to collect receivable, and how much time it has to pay its bills without incurring penalties. So this is the formula for cash conversion cycle. Inventory conversion period plus average collection period minus deferral, payables deferral period. Now, what is inventory conversion period? The average time required to convert raw material into finished goods and then to sell them. It is the average number of days that a company holds its inventories before selling it. The inventory period calculation shows how quickly a company can turn inventory into cash, and this is the formula. Inventory conversion period is equal to inventory divided by cost of goods sold per day. So you have to convert your total cost of goods sold into days, per days. The second thing is inventory collection period, or it is also called day sales outstanding, DSO. The average length of time required to convert the firm's receivables into cash, that is, to collect cash following a sale. DSO is the number of days on average it takes a company to collect its receivables. Therefore, DSO measures the average number of days for a company to collect payment after a sale. And this is the formula of DSO. DSO is equal to receivables divided by sales per day. Means you will have to convert total sales into sales per day first. The next thing is payables deferral period, which is also called days payable outstandings, DPO. The average length of time between the purchase of material and the labor and the payment of cash for them. DPO is a number of days on average it takes a company to pay back its payables. Therefore, DPO measures the average number of days for a company to pay its invoices from trade creditors, that is suppliers. Payables deferral period is equal to payables divided by purchases per day or payables divided by cost of goods sold per day. If we have purchases in a problem, then we will take this formula, and if we don't have purchases, then we will take a cost of goods sold formula. So here are the problem. From your course pack, page number is 567. We are going to start 15-1. The cash conversion cycle. Primrose Corporation has $15 million of sales, $2 million of inventories, $3 million of receivables, and $1 million of Payables. The cost of goods sold is 80% of sales, and it finances working capital with the bank loan at an 8% rate. Means the company finances its working capital through bank loan, and bank charges 8% interest on that loan. So the first requirement is, what is the prime rose cash conversion cycle? This is the first requirement. The second requirement is, if the prime rose could lower its inventories and receivable by 10% each and increase payables by 10%, all without affecting sales or cost of goods sold, what would be the new cash conversion cycle? So, new cash conversion cycle is required after making changes on inventories, receivables, and payables. Then, how much cash would be freed up, and how would that affect pre-tax profit? So, we have to answer three questions. This number one, cash conversion cycle before the changes, cash conversion cycle after the changes, and the cash freed up. This is the third requirement. And fourth requirement, how would that affect pre-tax profit? So we are going to solve it. We have sales. Sales is given 15 million. Inventories are 2 million. Receivables 3 million. Payables 1 million. And the cost of goods sold is 80% of sales. So we have 15 million sales. If, or you can say, the sales is equal to 80% into $15 million. So we have, you can say, $12 million. Okay, and interest rate is also given 8%. Cash conversion cycle is required. So this is the formula of cash conversion cycle. Inventory conversion period. So we have inventories. First of all, we have inventories. Inventories are 2 million divided by inventories are divided by cost of goods sold. So cost of goods sold is 12 million, and it should be multiplied by 365. Okay, or simply you calculate the amount. So this is 60.833 days, or you, in simple word, you can say that 61 days is the inventory conversion period. Receivable formula is accounts receivable divided by sales. So we have 3 million account receivables divided by sales. Sales is 15 million. And then we will have to convert it into days. That is 365. Yeah. So by calculating, we get 73 days. And payable deferral period is accounts payable. How much accounts payable is 1 million. Divide by cost of goods sold, multiply by 365. So The payable deferral period is 30.416 days. And the cash conversion cycle is simply we add inventory conversion period and receivable period, and we subtract payable deferral period. So just add these two, inventory conversion period, 3, 6, 8, 9. So inventory conversion, cash conversion cycle is 103.41 days, or you can simple say cash conversion cycle is equal to 104 days. Okay, so this is the answer for requirement 1. In requirement 2, they have decreased, lowered the inventory by 10%. Okay, so we are going to calculate inventory, receivable and payables figures again. We decrease inventories and receivables by 10%. So inventories are 2 million. 2 multiplied by 1, 10%, or you can say that so inventories are 2 million minus 10%. So new inventories would be 1.8 million. Similarly, U minus 3 minus 10% of 3 million. So 2.7 receivables, and the payables are increase by 10%. So 1 plus 10% of 1. So payables would be 1.1 million, and they have mentioned that sales and cost of goods sold remains constant. So we are going to solve cash conversion cycle again. Okay, the new inventory is 1.8 divide by cost of goods sold multiply by 365, or 54.75 days. Receivables collection period, the new receivable collection period is new receivable amount is 2.7 million divided by sales into 365. There is a new payable deferral period. Now the new payable amount is 1.1, but cost of goods sold remains unchanged. Multiply by 365. So the new cash conversion cycle is 3 plus inventory conversion period plus receivable collection period, and by subtracting payable deferral period. So new collection period would be, cash conversion cycle would be 87 days. 87 days. So this is the answer of part. Second part, the third requirement is how much cash freed up. So this was requirement 1. Okay, and this was requirement 2. The third requirement is total cash freed up. Okay, so we first take the changes in inventory, then changes in receivables, then changes in payables. Okay, so we had this one, 60.8 days before the changes and 54.75 days after the changes. So we subtract these days from each other. So we get the days increase or decrease. So 60.833 minus 54.75. Okay, and then simply we multiply it by cost of goods sold per days. These are the dollar amount, million, changes in working capital, freed up capital. Again, we take receivables before changes, which is 73 days, subtract 65.7 days, and then multiply by sales per day. So we are getting total cash freed up. Now, the payables period was 30.4167 before the changes, and after changes is 33.458. Then multiply it by cost of goods sold per day. Okay. So by adding all three, 0.4 million are the cash freed up, total cash freed up because we have taken these figures into in millions, 12 million, 15 millions, and 12 million. So this amount is million. Or if we convert it into lakhs, you can say 4 lakh dollar is the capital freed up, total cash freed up, total cash freed up. Okay. So the last requirement is pre-tax profit. So pre-tax profit, total cash freed up are 4 lakh, whereas the interest percentage is 8 percent. Okay. So total freed up capital would be 4 lakh, whereas the interest on it, or in simple word, you can say pre-tax profit is $32,000. So this is the last part answer. So that was 16-1. We have, I think, in my course pack it is 15-1. In your course pack it is 16-1. The difference is because of the addition. Okay, class. So the next problem is 15-4 from your course pack and page number 568. The cash conversion cycle. Again, it is about the cash conversion cycle. So Zoco Corporation has an inventory conversion period of 75 days, an average collection period of 38 days, and payable deferral period of 30 days. So what is the length of cash conversion cycle? Cash conversion cycle is required. We add inventory and collection period, and we subtract payables deferral period, so we get cash conversion cycle. The other part is if Zoco's annual sales are, so sales is given and all sales are on credit, what is the investment in accounts receivable? So accounts receivable is required, okay? How many times per year does Zoco turn its inventory? Assume that the cost of goods sold is 75% of sales. So inventory turnover is required. So here is the Excel sheet for the solution. The first requirement is cash conversion cycle. So cash conversion cycle is simply by adding days to turn inventory plus days to convert, uh, collect receivables, and minus payables deferral period. Okay. So 83 days are cash conversion cycle. The second requirement is accounts receivable amount. So this is the formula of receivable conversion period. This one, okay. So we are going to solve it through this formula. Cash conversion period is given. So just write down 38 as a cash collection period. Cash collection period is given. We have to calculate accounts receivable, divide by sales. Sales is how much sales was given? 34, 21, 875, and multiply by 365. Okay, So we have taken this formula to solve this problem. This one. So 38 multiplied by sales by simple mathematics. Okay. 3, 4, 21, 875 divide by 365. So accounts receivable would be 3 3,56,000 and 250. Here's the dollar amount. So this is accounts receivable. Okay. This was your one requirement, requirement A, requirement B, and requirement C. They ask inventory conversion. In inventory turnover. And this is the formula of account receivable turnover. Okay. For calculating the third requirement, we take this formula, C part. So account receivable, we forget this one in the formula. Okay. So accounts receivable turnover is equal to net credit sales. So sales are given 3,4,2,1,8,775 divide by average accounts receivable. We have just calculated accounts receivable in requirement 2, 3,56,250. Okay, so the inventory turnover would be 9.6 times. Okay, it should be in times. So this is your inventory turnover requirement C. They may ask inventory turnover. This is accounts receivable turnover. So what if they ask inventory turnover? So for inventory turnover formula is cost of goods sold divided by average inventory. Okay, so cost of goods sold divided by inventory. So first you will have to calculate inventory through inventory conversion period. We have in the formula of inventory conversion period in the previous example. Here it is a formula of inventory conversion period. Okay, so this is the formula of inventory conversion period. We have 75 days. We have 75 inventory conversion periods are given 75, that is 75 is equal to, now we are going to calculate inventories divided by cost of goods sold. So cost of goods sold is 12 million and multiply by 365. So by simple calculation, we get inventories. What is the procedure? That is 75 multiply by cost of goods sold. Um Inventory is 75% of sales. This formula is given. So we multiply 75 inventory conversion days with 75% of sales. So sales is 3421875. Okay, and then divide by 365. So average inventories are 55 lakh 27,343. Here it is in dollar amount. This is the answer of this is total inventories, or you can say in average inventories are given. The last thing is inventory turnover. So inventory turnover formula is cost of goods sold. Cost of goods sold is 75% of sales. So sales is 3421875. Divide by average inventory. We have just calculated average inventory 5,27,344. Okay, so 344. So the inventory turnover are 4.86 times. So class, in the problem from your course pack, they actually ask about inventory turnover period. This was the requirement A, this was requirement B, and this was requirement C. But I have also calculated inventory turnover and inventory conversion period for your practice. Okay, class? So that's it for today's lecture.